What's up, YouTube family? It's Prince Donnell, founder of Jumping Jack Taxes, and also the creator of Kangaroo Heroes NFT project that I haven't spoken to many of you about in the past. This is actually my first YouTube live, which I'm a little nervous but excited about. And today we're going to be talking about, tax basics for crypto and NFTs, how to avoid taxes on NFTs. I said avoid, not evade. We're going to be talking about that a little bit, especially for those of you who are active investors in crypto and NFTs, because of course this space is blowing up. With this space blowing up, I wanted to also get into the space as well, because I wanted to get a good understanding of how the taxes worked and also offer a ton of utility to those that are interested in NFTs. So aside from, obviously being a founder of Jumping Jack Tax, with us offering personal and small business tax preparation, we now launched a project called Kangaroo Heroes NFT, where now if you actually hold a Kangaroo Hero, one of the biggest benefits is that if you're a small business owner, you're going to get 30% off of all of our financial services, from personal and small business tax, bookkeeping, tax planning, that. And then also we're going to be hosting a huge Jumping Jack Tax and Kangaroo Heroes financial conference each year. And if you're a Kangaroo Heroes NFT holder, you're going to be able to come to this conference where we're going to be discussing crypto and NFT investing, taxes for small business owners, how to scale your small business, establishing it the right way, going through the legal ramifications to ensure everything is protected when it comes to your business insurance. And as a Kangaroo Heroes holder, you're going to get access. And I'm really excited about this NFT project, so definitely make sure you check it out. The NFT project, you can go to kangarooheroes.com, and we're going to be live at 8:00 p.m. tonight, January 5th, 2022. We actually are going to be live minting the Kangaroo Heroes, so the website will be live at 8:00, kangarooheroes.com. With that being said, let's jump right into it. Let's talk about tax basics for crypto and NFTs. I got an amazing presentation for you all that's going to be breaking down the basics over these next 20 to 30 minutes while I have you here. And we're going to talk about what's taxable and how to avoid it, because I know there is a lot of people who are in this space right now who don't believe that taxes actually exist in crypto land, in the NFT land, but that's false. So let's go ahead and talk about it. Let's pull up presentation. Let's get this thing going, baby. So let's talk tax basis for cryptos and NFTs. What's taxable and how to avoid it? I know y'all love my jacket. I got this made custom. I know y'all love it. So first things first, cryptocurrency and NFTs are taxable. Even if you don't agree, this is not an opinion. The IRS has made it clear, and the first question that they ask on your tax documents is, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? They're asking you this question to know if you've actually sold cryptocurrency or NFTs. So if you answer no to this question, that could be considered tax evasion. And that's subject to tax penalties, interest, or the worst case of jail time. Not to say that they would go that far to do that, but obviously when you say no on tax documents, the risks that come with that could be severe. So that's the first question that they ask on documents. So yes, it is indeed taxable, and it's not my opinion. It's what the IRS is stating. So that's important for you to know. So do that at your own risk when you're moving forward when it comes to doing your taxes this upcoming year, okay? Now let's talk about what is a taxable event. A taxable event is any action or transaction that may result in taxes owed to the government. So when you perform a taxable event, it could result in a gain or a loss. Let's break down an example of what a taxable event is when it comes to cryptocurrency. So taxable events for investing in crypto, here's a few different ones that you need to know. If you sell your cryptocurrency or you sell your NFT, that's a taxable event. If you're swapping from one coin to the next, that's a taxable event. If you're gifting cryptocurrency, that's a taxable event. Now remember, when I talk about gifting, that doesn't mean you're going to have to pay taxes on gifting. I'm just saying that it is indeed a taxable event. Taxable events do not mean that you actually have to pay taxes. We'll get to that in a second. And also, if you're buying goods with cryptocurrency, that's a taxable event. What do I mean by buying goods with cryptocurrency? So, for example, when you purchase Ethereum and you're using that Ethereum to purchase NFTs, you're buying goods with your crypto. That's a taxable event. Now, a taxable event does not mean you'll owe taxes. It depends on if the event resulted in a gain or a loss, which we'll talk about here. So, now that we understand that, what is a capital gain or loss, right? A capital gain is profit from the sale of an asset such as stock, real estate, or in this case, cryptocurrency. That is a capital gain is profit from the sale of an asset. So let's give an example based off this presentation here. You purchased Ethereum for $500 and then it appreciated in value, so it sold for $1,000, right? So the capital gain would actually be $1,000. Okay, $1,500. $1,500 is what you actually sold it for. $500 is your actual cost basis. So now you have $1,000 capital gain. Now, a capital loss is when you lose money from the sale of an asset such as stock, real estate, or in this case, cryptocurrency. So as the same example, you purchased Ethereum for $500 and then you ended up selling that Ethereum for $300. So now the capital loss would be $200 because you bought it at your cost basis of $5, you sold it for $3, you took a loss of $200. That's the simple explanation of what a capital gain and a capital loss is on an asset, and that's what that's what crypto and NFTs are subject to. Now, here's what's important to understand. Now that you know capital gains and losses, cryptocurrency is subject to short-term and long-term capital gains tax. So, short-term capital gains tax, it happens when you're selling your cryptocurrency less than 12 months. So if you dispose of your crypto, such as Ethereum, in less than 365 days, that's a short-term capital gains tax. On the opposite side, a long-term capital gains tax is when you hold your crypto for longer than 12 months, longer than 365 days. I like to say 366. You hold for 366, that's a long-term capital gains tax. Let's talk about why those are important, because they both have different tax ramifications that could lead to either a massive tax bill or massive savings. So let's break this down. If you sell your crypto in less than 12 months for a profit, you could pay up to 37% in tax, depending on your total taxable income at the end of the year. So I added the federal income tax bracket so that you can understand, right? So as an example now, if we're looking at this tax bracket and I had my cryptocurrency and I sold I sold in 6 months as opposed to selling in 12 months. Well, now let's say that I had a capital gain of $10,000. Well, if we look at this federal tax bracket, if I land in the tax bracket of 24%, then I could end up paying 24% on my capital gain, all because I sold less than 12 months. Now, on the flip side now, if you hold your cryptocurrency for at least 366 days, then your overall tax is dramatically lower. So look at the long-term capital gains tax rates, folks. If you're a single person and your taxable income is only up to $40,000 in a year, you pay 0% in taxes on your gains if your income is up to $40,000. And then the maximum rate is 20%. Or long term. So if you hold for 366 days, you're only paying up to 20%, as opposed to short term, you could pay up to 37. So I want to start this off by all of you saying it with me. Please say it for me in the comments, everything. I'm always taxed lower when I hold an asset for at least 1 year. I want all of y'all say it with me. Say it with me. I'm always taxed lower when I hold the asset for at least 1 year. That is massively important. That right there is a gem in itself. You keep it simple and hold for a year, then you don't got to worry about having to pay a lot in taxes. Let's give an example here. I'm going to give one example. Let's say that you purchased 5 ETH for $15,000, right? So now your cost basis is now $15,000 or $3,000 per coin. Because if I got 5 ETH, that means I have 5 coins. I break it up. That's each coin is worth $3,000. Okay. Now, What is cost basis, Don? Because you're talking about cost basis. Cost basis is basically the original price of what you paid for the asset. So what did I pay for when I originally got it? That's my cost basis. Now 6 months later, I sell my 5 ETH for $45,000. Okay. Now that sale resulted in a taxable event, and then the profit resulted in taxes owed. So now if I have $45,000 in current value, and then I have a $15,000 cost basis, what I originally bought it for, that means that I now have a $30,000 short-term capital gain, which the reason why is because I sold in 6 months as opposed to selling after 365 days. Now let's give a further breakdown so you understand. You also earn a yearly salary of $65,000 per year. And by the way, that's one of our kangaroo heroes right there, our NFTs. Don't mind him. He's just chilling. You earn a yearly salary of $65,000. Since you sold less than a year, the ETH is now subject to short-term capital gains tax, which is taxed at your ordinary income based on the tax bracket that I gave earlier. Now that $65,000 salary plus your $30,000 capital gain could now move you to a 24% tax bracket. So you'll end up paying roughly $7,200 in taxes on that $30,000 gain, all because you sold less than a year. Now, in the same example, let's use the same exact example that I just explained, but yet you held for 13 months as opposed to 6 months. Let's break this down. If you sold in 13 months with the same $65,000 salary example now your ETH is now subject to a long-term capital gains tax, which is up to 20%. So now your $65,000 salary plus that $30,000 capital gain now moves you to a 15% tax bracket, which means that you're only paying $4,500 in taxes on that $30,000 gain as opposed to $7,200. You just saved money right there from holding, ladies and gentlemen. So say it with me one more time. I'm always taxed lower when I hold an asset for at least 1 year. Holding that asset just saved you $2,700. Don just saved you $2,700 just for holding. I saved you $2,700 for holding, right? Now, let's move along. Losses can offset your gains, okay? So if you took a loss on like we talked about earlier in our presentation, that you can indeed take a loss on if I buy Ethereum at 1,000 and the Ethereum drops to $600 and I sold, then now I have a $400 loss. So if you took a loss on a crypto transaction, you can use that loss to offset other gains that you had throughout the year. So for example, you had an $8,000 gain in other coins, right? Let's say you had an $8,000 gain in Doge, right? You had $8,000 gain in Doge, but you had a $5,000 loss on Ethereum. You now have a net capital gain of $3,000 for the year, where you would have to pay long or short-term capital gains tax based on how long that you held. Your loss could even offset the total gain, right? So your losses offset the gains, and that's a really good strategy that many people use all the time, and it's definitely something to think about when it comes to your taxes, right? Now, here's something to be careful of before I move into the 7 things that you can do to be able to to avoid taxes on crypto. Number 1, it's something to be very careful of. Like we talked about earlier, if you buy things using your cryptocurrency, such as using your Ethereum to buy an NFT. Now, let's say that you bought a Kangaroo Hero using your ETH. That's considered a taxable event and is possibly taxes owed. So let's give an example of that. You buy a half a coin of Ethereum for $3,000. And by the way, this is just an example. I don't know the price of Ethereum right now. I'm not looking at it. You buy a half of a coin of ETH for $3,000. That ETH appreciates to $4,000. Now you buy an NFT for a half of ETH as well. So you now are going to have to pay a capital gain on $1,000 for buying that NFT, right? Because you used the full $4,000 to purchase an NFT. Technically, when you bought it, it was $3,000. It appreciated the $4,000. Then you used the entire $4,000 to buy an NFT. That's a $1,000 capital gain. Now that whole $4,000 is inside of that NFT, and what can end up happening is you now have a tax bill, but your tax bill is sitting inside of your NFT. It's something to be very careful of, and people don't really understand that when they're just going and using their ETH to buy NFTs, and they're like, well, you know what? I don't have tax. No, you're still going to have a tax bill because technically you disposed of your Ethereum when you bought the NFT. Be careful of that because you could get caught, right? So be careful of the tax bill. So now let's talk about taxable events for investors. Selling your crypto is a taxable event. Swapping from one coin to the next is a capital event. Gifting your cryptocurrency is a taxable event. And also buying goods with your crypto is a taxable event as well. Now let us... One more thing here before I move into the 7. So here's what's important to know. I'm encouraging each and every one of you all who are buying cryptocurrency and NFTs and etc. Please, I am recommending you that you use CoinTracker. This CoinTracker, this allows you to connect all of your wallets, and it tracks all of your transactions that you're making so that at the end of the year, you're structured and you know what's happening, right? Because you don't want to get caught up in a scenario where you have all these transactions all over the place. You weren't tracking your gains and your losses. And then now when it comes time to do your taxes, man, it's a scary moment because you end up with a large tax bill because you weren't keeping up with it. CoinTracker will solve all of that for you. And this is not a sponsorship. This is what I use, and I'm encouraging you to do the same. Now, let's end this off right now because I didn't want to have a super long live. I wanted to make this short, and I'll go into a deeper one as we get further into January. I'm going to go into a deeper presentation for you all. But let's quickly talk about the 7 ways that you can legally avoid taxes on cryptocurrency. First, let me start off by saying that tax evasion and tax avoidance are 2 different things. Tax evasion means that you're concealing income or information from the tax authorities, which is illegal. Tax avoidance means you're legally reducing your taxable income. I'm encouraging all of you to now lean towards tax avoidance, not towards tax evasion. Okay, and there are a lot of ways that you can do that, which I'll talk about. Number one way that you can avoid taxes on crypto is HODL. What is HODL? Hold on for dear life, right? When you hold and you don't sell, you won't ever have to pay taxes. You won't ever have to pay the tax. Or you'll pay long-term capital gains tax, which is much cheaper than short-term. So holding creates generational wealth. Okay, hold. When you hold, you don't pay tax. Keep that across your head. When you hold, you don't pay tax. Number 2, this one is through loans. Now, I will make a disclaimer here. Loans are very risky to do, but I'm still going to explain what this is. Remember, you only trigger a taxable event when you sell the cryptocurrency. But what if you want to use the actual gains from your crypto to buy more crypto or other assets? So you could put your crypto portfolio up as collateral. And when you do that now, you can loan against it in order to get the cash. So loans are not taxed. And not only is it not taxed, you still now own the asset as well because you never sold it. So it could still appreciate in value while you have a loan against it and you're buying other assets. Now, it's important to remember as a disclaimer, if you're putting your crypto as collateral on a loan, that can present risk because they can end up making a margin call. Because what that means is if your crypto portfolio falls underneath a certain required value amount that the collateral was supposed to be, then now a margin call can happen where you now have to put more cash into your portfolio to cover for the collateral. So that's why I don't suggest that beginners loan against their portfolios. This is for experienced people who have larger crypto portfolios and they're trying to figure out how to access the cash without having to sell and having a large capital gain tax. So number 3 is to give a gift. Gifting creates a taxable event, meaning it must be reported, but you don't have to pay tax on sending a gift, and the person receiving the gift doesn't have to pay tax either. So you can gift up to $15,000 per person per year tax-free, right? So here's another disclaimer. The IRS knows that gifting could be abused, so they watch this very closely. Make sure that it's a bona fide gift, meaning you are not expecting to receive anything in return for this gift. If somebody did something for you and then you gave it to them, gifted it to them, that could turn into becoming a red flag. So make sure that your gift is bona fide. You're not getting nothing in return for that. Number 4, the way that you can avoid paying taxes on crypto is a self-directed IRA. This is one of my favorite ones. A self-directed IRA is an individual retirement account that allows you to buy alternative investments such as cryptocurrency. You could open a self-directed Roth IRA and all of the gains could be tax-free in the future when you retire. Here's another disclaimer here though. If you open a self-directed IRA, keep in mind that you can't touch the capital gains. You can't touch those gains until you're 59 and a half, or you'll risk having to pay tax penalties. So if you touch your IRA prior to 59 and a half, you could pay a 10% tax penalty, which is steep, you know, on whatever that, on whatever you took out of your IRA. So make sure that if you were to take the route of a self-directed IRA, that is definitely with funds that you don't intend to touch for years to come until 59 and a half. That's very important. But this is indeed a great option to start building towards for your future when it comes to retirement. And we can dig deeper into this as far as what type of self-directed IRAs there are and what are some of the best companies to move in with. Number 5, capital losses. Remember, you can use the capital losses to offset your capital gains. So as an example, you lost $5,000 in ETH, but you have $5,000 in gains through Doge. You can offset that gain with the loss on ETH. I believe the IRS is indeed adjusting that rule in a bit. So in a later presentation, I will indeed make an update to this on the changes that they're making to capital losses on cryptocurrency. So stay tuned. Number 6, you could donate your appreciated cryptocurrency. This one I think is a great one just from the heart. If you donate your appreciated cryptocurrency to charity, this allows you to avoid capital gains tax as well. So you're doing a great deed. You find a organization that you want to donate to, you could donate that appreciated crypto, don't end up having to pay any tax, and you were able to change people's lives at the same time. Good for you, right? That's awesome. Last but not least, moving to Puerto Rico. I'll disclaim this first. I'm not an attorney, so I don't know all of the laws around moving to Puerto Rico, but I will put this out there so that you all can go down the rabbit hole and you can look forward and find somebody who specializes in this. But there's a bunch of info out there about people moving to Puerto Rico so that they don't have to pay capital gains tax. This is true on the face level, but there's a lot of regulation, with the biggest requiring you to renounce your U.S. citizenship and becoming a bona fide resident of Puerto Rico, amongst other things. So find someone who specializes in the laws surrounding this loophole. Don't take my word for it. Go talk to attorneys, those who specialize in this move to Puerto Rico, because there are some, and they can walk you through that process if you want to be crazy enough to do that. And that's normally for somebody who has larger than normal capital gains, investing into crypto, and etc. So just to do a final recap before we go, here's some taxable events. If you're selling your crypto, if you're swapping from one coin to the next, if you're gifting crypto, if you're buying goods with crypto, those are all taxable events. If you're mining, staking, airdrops, if you're getting paid in crypto, those are taxable events. What's not a taxable event? If you're buying cryptocurrency, that's not a taxable event. If you're transferring from one wallet to the next, that's also not a taxable event. So I hope that this was helpful for you. I want you to share this video with a friend that's investing in crypto and investing into NFTs, because we really want to get this information out there so you guys don't get caught with red flags or huge tax bills in the future, right? So share this video. Also, you can join my Kangaroo Heroes Discord community. I'm going to put that in the description below. Inside of the Discord community, we talk about crypto and NFT taxes. On top of that as well, you also can purchase a Kangaroo Heroes NFT, which I told you in the very beginning. It gives everybody 30% off of all of our financial services at Jumpin' Jack Tax, from personal and small business tax, bookkeeping, tax planning, and it gives you a ticket to our Kangaroo Heroes and NFT financial conference that we're having each year, where we're going to be discussing a lot of topics from investing, tax and accounting, small business tax, scaling, adjusting your books, and this gives you a ticket to that as well. So definitely go to kangarooheroes.com, get into our Discord, and get the knowledge and information. So with that being said, thank y'all so much for joining. This is our very first live. We plan to have so many more lives in the future. I want to go live at least 2 to 3 times a week, talking about tax and accounting for small business owners, scaling your business. So if you have any questions or any topics that you would like for me to discuss, please drop them all in the comments below. We're going to be choosing from those, and I'm going to be going live discussing that and putting together some great presentations so that your year of 2022 goes to the next level. Please make sure you like, comment, subscribe, and get a bunch of of people into this channel right here so that when we go live, we can change people's businesses. With that said, I'm Prince Donnell, founder of Jumping Jack Tax. If you need your taxes done, personal, small business, etc., go to jumpingjacktaxes.com and book an appointment, and our team is going to be able to help you. And we handle virtually in all 50 states to be able to assist your business with your tax and accounting, bookkeeping, life insurance, whatever it is you need. Peace.